Okay, now we're starting on the estate and gift tax portion of the course. And so here we have an introduction to the gift tax. Okay, the gift tax is a transfer tax, and that means that a transfer tax, it's a tax imposed when a transfer of ownership is made. The estate tax is also a transfer tax. Gift taxation is closely related to the estate taxation, but we're going to separate them in this presentation. As you can see, we'll get to the estate tax. Now, the gift tax is not reported on the Form 1040. If and when gift tax is due, it's not an income tax, so it's not going to be on that Form 1040. It has its own form. So our case study here is this. Mr. and Mrs. Smith hand the keys to a new Jag to their son Al and his wife Josie for their 10th wedding anniversary. Very nice. Okay, this Jag has a fair market value of $80,000. So they're concerned about gift taxes. They're aware that there's some kind of gift tax. So do the Smiths or Al and Josie need to pay gift tax or file a gift tax return? So here you're consulting with Al and Josie. They want to know if they're going to owe anything. Well, the first thing we need to do is to determine if a gift has occurred. Now, this may seem like it's real obvious, but you're going to have cases where it is not obvious whether a real gift has occurred or not. Now, first of all, we've got to define what a gift is. One, you have to have a voluntary transfer. So if someone has a gun to your head and they make you clean out your checking account to give them cash, that is not a gift, right? It's not a voluntary transfer. Also, there has to be a complete transfer of property. In other words, Al and Josie have title. The parents are going to have no control over this car in order for it to actually be a gift. Also, the transfer of ownership has to be without full consideration. So there's going to be a lot of like legalese in here. Consideration just means an example of full consideration would just be that Al and Josie paid $80,000 to the Smiths. In other words, did they buy it? No, they got it without paying full consideration. So Al and Josie, they gave the Smiths less than $80,000 for the car. So in this case, they paid nothing for the car. So has a gift occurred? Sure. Now, here's some other requirements of a gift. The donor must have the intent to make a voluntary transfer. They have to be competent to make the gift, which means that they have to have attained the legal age of majority. So for a child to give a gift is a problem. They have to have the mental capacity to make a gift. So this usually comes into play most commonly with elderly people who may be suspected or have some sort of dementia. To be competent to make the gift, you have to own the property or have a general or limited power of appointment over the property. So you cannot gift property that you don't own. And you must part with dominion and control over the property. So some more legalese. This makes it a completed transfer as opposed to an incomplete transfer where the donor still has some control over the property. Incomplete gifts are not gifts for gift tax purposes. So if if the Smiths had just given Al and Josie the keys to the car, but the Smiths kept title to the car, this would be an incomplete gift. They kind of did some of the stuff to make it a gift, but not everything. So the Smiths have to give up complete control over the property. Now, other requirements of a gift: the donee, the person who receives the gift, or the guardian, they must be capable to receive the gift or be identifiable. We have to know who the gift was given to, and they must actually get the gift and take delivery and accept the gift. Now, two types of gifts that we'll talk about are direct gifts and indirect gifts. Direct, the property is transferred directly to the donee, just like this car. You give them cash, you give it right to them, or you can have indirect gifts. So the donor pays a legal obligation of the donee. Okay, so if you pay somebody's mortgage for them. So in prior years, Mr. and Mrs. Smith paid some of Al and Josie's condo repair bills and mortgage payments. So those are gifts and considered legal gifts, but they're just indirect gifts. In a prior year, Mr. and Mrs. Smith retitled their vacation home so that Al and the Smiths are joint tenants with rights of survivorship. Okay, And what this means is that they made a gift of half the value of the home, joint tenants with right of survivorship. Also in a prior year, Mr. and Mrs. Smith made a loan to Al and Josie at 0% interest rate. So recall that we're going to have imputed interest issues here, and that imputed interest is considered a gift. Joint tenants with right of survivorship, you may or may not know exactly what that is, but it gives an undivided interest in property held by two or more related or unrelated persons. So when one dies, the other inherits the deceased interest, and the deceased interest does not have to go through probate, which is a really, really big deal. So an undivided interest means that there is not a piece of the property that specifically belongs to one of the owners. Like this vacation home of the Smiths, it's not like Al owns the north half of the home and the Smiths own the south half of the home. They all own all the home, but they only own half of it, but you can't tell exactly which part of the home each one owns. So, for example, when Mr. Smith dies, assuming he dies first, Mrs. Smith and Al will then each own half the vacation home. So they'll each own half of the whole home. Read about joint bank accounts in estate planning. Yeah, with joint bank accounts with joint tenants with right of survivorship, there's actually not a gift until the second person actually withdraws money. So we're still back to our question. Do the Smiths or Al and Josie need to pay gift tax or file a gift tax return? So you have determined that there has been a completed direct gift in this case. So the next question is going to be to determine the value of the gift. Now, in this case, the fair market value of the gift is very easily determined. It's $80,000. Now, if you want to, pause and read down here how to value real estate, publicly traded securities, bonds. The fair market value of the gift is not always just real obvious. Sometimes you have to do a little work to figure out what it is. This last star here, I want to spend a moment on. The valuation of a gift. Discounts may be allowed for lack of marketability, lack of liquidity, and lack of control. And I want to just note this because this is a review of information we've had earlier about family limited partnerships. So here's our example. Jamie owns a 5% interest in a family limited partnership. The value is $1 million. So 5% times $1 million is $50,000. But Jamie's shares are not valued at $50,000. They are discounted because as a 5% shareholder, Jamie has no control over the business. So a common discount rate is 30% is commonly used for family limited partnerships. So Jamie's shares will be valued at $35,000, 50,000 times 0.7. Now, and you need an appraiser for this. An appraisal is necessary because the interest isn't sold, it's being given. So if it was being sold, then we would know the fair market value. But since it's being given, we have to come up with some other way to value it. So just a review of discounts for family limited partnership interests. Now, do Al and Josie still need to pay gift tax or file a gift tax return? So you tell them the donors, the parents, the Smiths, are going to pay the gift tax and file a gift tax return if necessary. Not because they're just being nice, but because legally the donor is the one that files the return and pays any tax it's due. So you say, I will discuss the gift tax with your parents to determine if they need to file a gift tax return or pay any gift tax. Now here's the gift tax return. You don't really need to know much about this for purposes of this course. I just want you to be very aware it's not 1040, it's Form 709. It is still due April 15th, however. Same due date as the Form 1040. So who has to file it? Anyone who makes a gift, unless the gifts are under the annual exclusion, which we're getting ready to talk about, unless the gifts are qualified transfers, which we will talk about later, unless the gifts are transferred to spouses generally, because, transferring something to your spouse, it's not really considered a gift, or transferred to charities. charitable contributions are not gifts either. So they are charitable contributions and can be deducted as itemized deductions potentially. So okay, so we do know there was a gift of $80,000. So do the Smiths file a return or pay the gift tax? Well, they're asking questions. So how much can we give annually to avoid paying the gift tax and avoid filing a gift tax return? So they're kind of aware that there's some kind of annual thing here. So there's an annual exclusion. So no gift tax will be due and no gift tax return must be filed. So it'll be easy if gifting during the year is at or under the annual exclusion. So, all individuals may gift up to $15,000 tax-free per donee each year. Now, this $15,000 is the annual exclusion. It's per donee and it's per individual. Okay, the $15,000, this is good for 2018 and 2019. This $15,000 is indexed, but it doesn't go up very often. So it may remain at $15,000 for several years. It may not, it depends, but it doesn't change every year like the standard deduction or other things that are indexed. Okay, the gift must be of a present interest, which just means the donee gets immediate use, possession, or enjoyment of the property, as opposed to a future interest, so they can enjoy it today. They don't have to wait and enjoy it later. So here's how the Smith's annual exclusion amount is going to work. So it's for each donor to each donee. So Mr. Smith can exclude $15,000 given to Al, $15,000 given to Josie. Mrs. Smith can exclude $15,000 given to Al, $15,000 given to Josie. So the Smiths, they can exclude $60,000 here without even filing a return or paying any gift tax. I mean, they could give $15,000 to as many people as they want. Right now, they're just interested in giving to Al and Josie. So there was a gift of $80,000. Do they file a tax return? So what you tell them is you'll have to file a gift or tax return because your gift was more than the annual exclusion amount. So, to keep things simple, which often is the goal, each individual should give $15,000 or less to each donee. But as you can see, that still can be pretty decent money if you've got a husband and a wife and they each want to give to each child, each grandchild, etc. Okay, the annual exclusion is Section 529 plans. Now recall that these Section 529 plans are tax-favored ways to save for higher education. Now the Section 529 plan rules allow a taxpayer to contribute 15 annual exclusion amounts in 1 year to the Section 529 plan. But the taxpayer will not be able to utilize the annual exclusion for the next 4 years. So 5 times the annual exclusion amount, $15,000 per donor, totals $75,000. So a taxpayer can contribute $75,000 in year 1. So the annual exclusion will be $75,000 because it was given to a Section 529 plan. However, for years 2 through 5, this donor will not be allowed an annual exclusion for whoever the beneficiary is of that Section 529 plan. If they give gifts to other people, then those other people still will be eligible for the annual exclusion. Okay, so spousal gifts, there's an unlimited spousal annual exclusion. This is tax speak way of saying gifts to spouses are not subject to gift tax. But if a spouse is not a U.S. citizen, the exclusion is limited. Be aware of that. So Mrs. Smith asked, this car was from both of us, but next year Mr. Smith alone wants to give $60,000 in cash to Alan and Josie. So what will be the annual exclusion next year? Well, as we know, Mr. Smith can give $15,000 to Al, $15,000 to Josie, but we need to be aware of things called split gifts. Now, married spouses can elect to split gifts, effectively doubling the annual exclusion per donee to $30,000. So let's say, for example, Mr. Smith gives $30,000 to Al, but Mrs. Smith goes along and she says, yeah, well, I will agree to this, and so we'll have a split gift, which basically means that she is going to claim $15,000 as a gift. So it does require a gift tax return if you're going to split gifts, even if the gifts are less than the annual exclusion. It has to be elected for all gifts that year. Now, next year, when Mr. Smith gives $60,000 in cash from his separate property, the couple can elect split giving, which treats half of the gift as coming from Mrs. Smith. So again, for next year, if Mr. Smith gives $60,000, we still have this situation, Mr. and Mrs. Smith, and so they can give their son and daughter-in-law a total of $60,000. They will have to file a gift tax return, but there will be no taxable gift. Now, couples don't need to elect gift splitting in community property states because any gifts from community property is half of it's from both spouses. Texas is a community property state. So what a community property state does is this. Let's say, for example, you have a husband and wife, and this only applies to husbands and wives or spouses. Let's say spouse one works, another doesn't, for example. So spouse one works. Let's say that spouse one decides to put some money into a checking account with only that spouse's name on it. In a community property state, even though that one spouse's name is on the checking account, it belongs to both spouses. So in non-community property states, if that spouse put money in a checking account with just that spouse's name on it, it would be considered separate property. Now, in a community property state, there also can be separate property. We don't really go into this, but you need to be aware what community property is and what a community property state is, because Texas is a community property state. So they want to know, bottom line, how much gift tax will we owe? Well, that's an easy question without an easy answer. All right, you can actually give millions of dollars during your lifetime and not have to actually pay any gift tax, even though you may have to file a gift tax return. So this brings us to the applicable exclusion amount. This is also called the applicable credit equivalency amount. Now, I think that it's really easy to get lost in the vocabulary of gift and estate tax, so just pay really close attention to this vocabulary and, work at getting comfortable with it as we go. So, in addition to the annual exclusion, each person also has one lifetime exclusion amount up to $11,180,000 as of 2018 of cumulative taxable transfer. So, lifetime exclusion, so over the course of your lifetime, you can exclude from gift and estate taxation over $11 million. Well, that's a good deal, huh? All right, now we have this applicable exclusion amount, and that is as opposed to the annual exclusion amount. They sound a lot alike, so just be sure you get straight in your head the vocabulary. And this annual exclusion, or the applicable exclusion amount, applies to each person, which means each person can give $11,180,000 cumulatively during his lifetime in excess of the annual exclusion amount without incurring any gift tax. Okay, you will have to file a gift tax return, but maybe not pay tax. So we have here a situation where Michonne is gifting to Carl. And you can see over in this far left column that she gifts in years 1, 5, 7, and 56. That was a long break. And you can see the amount she gives to Carl in each of those years. Now, every year that she gives this money to Carl, there's an annual exclusion of $15,000. And so, for example, in year 1, you can see that the taxable gift is $1 million minus the $15,000 or $985,000. Now, again, vocabulary is an issue here because this says taxable gift. And so you would think that $985,000 would incur some tax, but no. A better a title for this would be potentially taxable gift, but we're stuck with this vocabulary, taxable gift. So you can see what it is. It's the million minus the annual exclusion. Now, this is the annual exclusion, but here in this slide we have introduced the applicable exclusion amount. So what we're going to do is add up the taxable gifts over Michonne's lifetime, and they add up to $5,336,000. But we do know the applicable exclusion amount is $11,180,000. And so, of all that over $5 million that we call taxable gifts, the amount on which gift tax is actually owed is going to be 0. Here's another example. So Ina gifted to Dana. Okay, so over the course of several years, Ina gifted Dana $4 million 4 times. Every year, we get the annual exclusion, and so all 4 of each of these years, the taxable gift was $3,985,000. Over the course of Ina's lifetime, then, she gifted $15,940,000. The applicable exclusion amount, as we know, is $11,180,000. $11,180,000, and so the amount on which the gift tax is actually owed is only $4,760,000. All right. Now, remember that this taxable gift doesn't mean you're going to incur a tax on it. It's potentially taxable, is what that means. So the amount on which the gift tax is owed is only $4 million plus. Now, the lifetime exclusion is per donor, not per donee, like the annual exclusion. So here we have another very generous person, O'Day. So in 2018, O'Day made gifts of $2,500,000 to Mary, Charlie, Jeannie, and John. Each donee gets the annual exclusion. So the gift to Mary incurred a taxable gift of $2,485,000, and to Charlie, Jeannie, John, etc. So for this taxable year, O'Day's taxable gifts were $9,940,000. But assuming he's never given anything prior to this, we have his lifetime exclusion, which is $11,180,000. So actually, he will have to file a gift tax return, but there will be no gift tax incurred because he hasn't given up to the lifetime exclusion. But the remaining lifetime exclusion gets reduced as it's used. And so here we have the same 2018 information. And O'Day's remaining exclusion after 2018 is $1,240,000, which is his lifetime annual exclusion minus how much was sort of used up in 2018. And so when we get to 2019, he continues being very generous. And so he gives $5 million to each of his 4 friends. Each donee gets the annual exclusion. Taxable gifts, $4,985,000 for each one. So in 2019, his total gifts, $19,940,000. But now, only $1,240,000 of it is shielded from tax because we've used up the rest of that lifetime exclusion. So he actually will incur gift tax on $18,700,000. This guy got big bucks, right? Okay. Now, okay. Now, gifts in excess of that lifetime exclusion are taxed at 40%, so that's pretty hefty. So for 2019, O'Day will pay $7,480,000, which is 40% times that $18,700,000 because he's used up his lifetime exclusion. Okay, the applicable exclusion amount, it's also called the applicable credit equivalency amount, and the applicable credit. So now we've got another similar sounding vocabulary word. The applicable exclusion amount excludes $11,180,000 of taxable gifts from taxation over a lifetime. Now, if those gifts were taxable, the tax on them would be $4,417,800. So the applicable credit is going to be that $4,417,800 of tax not paid. So that's what they mean by the applicable credit amount. It's going to change a little bit every year, which just makes it kind of miserable in terms of making calculations. But that's what the applicable credit amount means. Now, this exclusion amount is per person, not per couple, which means that each spouse gets $11,180,000. So the couple, as a couple, can give away $22,360,000 in taxable gifts during their lifetime without paying any gift tax. So, in order to answer their question, how much gift tax will we owe, you've got to know how much have you given in gifts before 2018. They tell you $5 million, so you've got an easy answer. No gift tax owed, but you will need to file gift tax returns. So, principles of gift tax planning. The good news for gift tax planning is that most clients can do lifetime gifting without worrying about paying the gift tax. Okay, basis and holding period of gifts in the hands of the donee. In general, the donee will take the adjusted basis and holding period of the donor. So that's easy. There will be a double basis if lost property is donated. So here's an example of a double basis. Mother has stock bought many years ago with a basis of $400,000 and a fair market value of $250,000 to the son. So this is lost property because if she sold it, she'd take a loss on it. So the son has a double basis because it's lost property. He has a gain basis, which would be $400,000. He has a loss basis, which would be $250,000. So if the son sells for $500,000, there's a $100,000 long-term gain because you use the gain basis. If the son sells for $200,000, there's a $50,000 long-term loss because you use the loss basis. Now, if you sell for in between, if the son sells for $300,000, then there's neither a gain nor a loss. Now, here's what qualified transfers are. They are wonderful things. These gifts are not considered taxable gifts. This is money you can gift without filing a gift tax return, yay, or paying gift tax, or using up your lifetime exclusion amount. So this is great. Qualified transfers are payments made directly to a qualified educational institution for tuition, not books, but tuition, or paid directly to a medical care provider for qualifying medical expenses of someone else. So you can basically gift money to actually anyone you want, usually children, grown children or grandchildren, right? By directly paying for education or medical expenses, and you don't even use up any of that exclusion amount. So gifting strategies should be based on the client's motive for giving. So here's some motives. To see loved ones enjoying the gift. So often giving direct gifts of property or cash, right, are a good thing if you want to actually see them enjoy the gift. Indirect gifts of property if you want to give them part of your vacation home. And again, often simplicity is desired. So for simplicity, keep the gifts under the annual exclusion. So remember, the annual exclusion is per individual donor for each donee. So a good amount can be spent on each donee without even filing a gift tax return, much less paying gift tax. Now, if you want to transfer income to a lower tax bracket, you can certainly give to family members or others. I mean, you can do it for others if you want in a lower tax bracket. Now, gifts to minors under this UGMA, which is Uniform Gift to Minors Act, you can usually, minor, you probably don't want to give it directly to them, right? You want to put it in kind of a trust, and this is a really simple thing to set up. Now, you need a custodian for the account, so the donor or the parents can be the custodian. You, the giver, can be a custodian, while the donee is still a minor. So remember that the gift is not going to be taxed to the donee, but subsequent income is, which is what you wanted because the minor is in a lower income tax bracket than the donor. But of course, remember that there is a kiddie tax, which means that probably, depending on the amounts, some of the income will be taxed at estate and tax rates instead of at the child's tax rate. Okay, you may want to provide a low interest rate loan or extend credit to a child with no credit or bad credit. So you've got a child that wants to buy a home. Maybe they can't get credit or you just want to give them a break, so low interest rate loan, so you can make a lower zero interest rate loan if you want. But remember, there will be imputed interest, which is considered a gift. Also, keep in mind, this is really important tax planning principle, that principal can be forgiven each year up to the annual exclusion. I say with no hassle, right? Again, without filing a tax return. So you could forgive $15,000 of the principal every year, and it is a gift, but it doesn't count toward the annual exclusion. You don't have to pay gift tax. You don't even have to file a tax return if it's $15,000. And if it's a husband and wife, you can each forgive $15,000 a year. You may want to help with current medical and educational expenses or just to help out with cash flow. So again, as we were just saying, pay the medical and educational expenses of loved ones directly to the institution. And remember, medical and educational expenses are qualified transfers, meaning they're not subject to gift tax. You can help save for higher education, contribute up to $75,000 in 1 year per donee. Per donor or per donee to fund your Section 529 plan. Or if you want to transfer ownership of a family business, consider using a family limited partnership, which involves gifting, but you get, usually valuation discounts. If you want to reduce the gross estate, would be an excellent reason for gifting, but we will cover that later.